Welcome to the Explainer. So you're an algorithmic trader. You've spent countless hours building what you think is a really promising strategy. But then you hit a huge wall of robustness tests. The real question is, how do you figure out which ones are absolutely critical and which ones are just, well, a total waste of your valuable time?
All right, let's get right into it. You did the heavy lifting, you've coded up your strategy, and that first backtest, it looks pretty good, right? So you open up your platform's validation tools and bam! This monster list of options is just staring you down. It's a lot. And you can't help but ask, seriously? Do I really need to run every single one of these? And yeah, this is exactly what that wall of tests feels like. You're looking at 15 different options, each one claiming it's going to help validate your brilliant idea. It honestly feels like you're about to burn days, maybe even a week, just running diagnostics on one strategy. But what if I told you that for a whole lot of strategies out there, a huge chunk of these, more than a third, are completely useless? See, the secret here isn't about running more tests, not at all. It's about running the right tests. And it all boils down to this one super powerful idea. You have to match the test to your trading time frame. This is the key. This is what unlocks a faster, smarter, and way more effective way to validate your work.
And this just says it all, doesn't it? Let's say your strategy trades on a daily chart of the NASDAQ. You know, one single candle represents a full 24 hours of market chaos. The price swings are massive. Now imagine using a test that's designed to analyze tiny little tick-by-tick movements on that kind of chart. It's like bringing a watchmaker screwdriver to a construction site to build a deck. It's the wrong tool for the job. So let's start by just clearing out the junk. Sticking with our right tool for the right job idea, we can immediately, get rid of two whole categories of tests for our daily chart strategy. This right here, this is where we start working smarter, not harder.
Okay, so the two main culprits are tests that focus on tick-by-tick data and all those little tests that simulate tiny market frictions, like spread and slippage. Just by identifying these two categories, we make our job so much easier. We can literally cross off 5 different tests from our list in one fell swoop.
So here's the thing. These 5 specific tests, they're designed to analyze noise. Noise that's so small it's statistically meaningless on a long-term chart. They're trying to solve a problem that, for our daily strategy, it just plain doesn't exist. Let's dig into why that is.
To really get why we can just ignore these tests, all we have to do is look at the difference in reality between timeframes. The whole context of your strategy is what decides what's actually an important signal and what's just background noise. I love this comparison because it lays it all out. Think about it like this. Our daily NASDAQ strategy is like climbing a mountain. An intraday scalping strategy is like watching the ripples in a small pond. On our mountain, a winning trade might net us, say, 200, maybe 300 points. Now, does a random 3-point slippage, a tiny little ripple, does that really threaten a strategy that's going for that kind of massive target? Of course not. It's basically a rounding error. For an intraday scalper, though, that tiny ripple could be their entire profit. For us, it's just noise.
So instead of wasting all that time and computing power running those microtests, you can get much better, more relevant results with just 2 simple moves. First, use the test that randomizes the OHLC, the open, high, low, close, of each candle. That's a great way to simulate the small differences in price data you might see from one broker to the next. Second, just set a pessimistic, fixed slippage value one time in your main backtest settings and you're done. Super efficient and way more effective.
Okay, now for the exciting part. We've cleared out all that noise. Now we can really focus our time and energy on the tests that actually tell us if our strategy's logic is solid, if it's durable, and if it's not just some random fluke we found.
This, right here, this is your core toolkit. These tests get to the absolute heart of your strategy. They answer the big questions. Like, is your profit curve just the result of a couple of really lucky trades that happen to fall in a row? The trade sequence tests will tell you that. Does your logic only work on the NASDAQ, or does it also work on, say, the S&P 500? That's market adaptability. And probably most important of all, parameter stability. These check if your strategy only works with one magic number, or if the logic is strong enough to work across a range of inputs. This is how you find out if you've discovered a real market edge, or if you just got lucky with curve fitting. These are the questions that really matter. So the big takeaway here should be a fundamental change in how you approach this. The goal isn't to get a long checklist of completed tests you can brag about. No, the goal is to get a deep, real understanding of your strategy's strengths and, even more importantly, its weaknesses.
And this is it. This is the one principle that should guide your entire validation process. When you focus your energy, your time, and your computer's processing power on the tests that are actually relevant to your strategy scale, you don't just work faster, you get a much clearer, more meaningful, and ultimately a more reliable result.
And that kind of leaves us with one last thought, right? This whole idea of matching the tool to the task. It doesn't just apply to robustness testing, it applies to, well, everything. So take a look at your own workflow. What other best practices or standard procedures do you follow without thinking that could maybe be streamlined or even thrown out just by asking that simple question? Is this truly relevant to what I'm trying to do?